Welcome back to Talk Tiggers. Today, we are diving deep into the Q3 2025 earnings from industrial gas giant Linde. This was one of those quarters that had some really strong results, but somehow still left investors feeling a little uneasy about what's coming next. Let's get right into it. So here's the central puzzle we're going to unpack today. Linde actually posted a record high for its adjusted earnings per share. On paper, that's a fantastic performance. And yet, the stock sold off on the news. This is that classic disconnect we just love to dig into, right? You got solid results meeting a really skeptical market. So what exactly happened?
Okay, let's kick things off with the headline numbers. This is the stuff that hit the wires before the market opened. And on the surface, it all looked pretty darn good.
So the adjusted EPS, that came in at $4.21, beating Wall Street's consensus by about 3 cents. Revenue was right in line with what everyone expected, at $8.62 billion. But here's what's really impressive. It's the operational strength. That adjusted operating margin, it ticked up again to a massive 29.7%, and operating cash flow grew a super healthy 8% year over year. These are the signs of a well-oiled machine, no doubt about it. But when you start to look just a little bit beneath the surface, the story gets a whole lot more complex. The key takeaway here is this regional split. The Americas were the clear bright spot, up 4%, and that was driven by both better pricing and more volume. But all that strength was basically canceled out by weakness everywhere else. The Asia-Pacific region saw a 1% decline, while Europe, or EMEA as they call it, fell a pretty notable 3%. And that was all due to this persistent weakness in volume, which really just reflects that broader manufacturing slowdown happening over there. This kind of tale of 3 different regions is absolutely key to understanding why the market reacted the way it did. So, how did the top brass frame these results? Well, their message was crystal clear. This is exactly what our business model is designed to do, perform through any kind of economic cycle. And this quote from CEO Sanciv Lomba on the call, it says it all. From his point of view, this tough macro environment isn't some new surprise. It's a reality they've been successfully dealing with for a long, long time. They're not just sitting around waiting for a recovery. They are actively executing through the downturn. In this strategy, it's really built on 4 key pillars. First, using pricing discipline to protect their best-in-class margins. Second, generating just massive amounts of free cash flow. It hit $1.67 billion this quarter alone. Third, they're using that cash to fund a record $7.1 billion project backlog, which is all about securing future growth. And finally, they're pointing to these huge long-term trends in electronics and the energy transition as durable drivers for the business for years to come.
So, if management was so confident and the execution was so solid, what on earth spooked investors? Well, as is so often the case, it all came down to the forward-looking guidance.
This slide right here shows you the core of the issue. While Q3 was a beat, the guidance for Q4, well, it raised some eyebrows. Management guided to an EPS range of $4.10 to $4.20. The middle of that range comes in just below what Wall Street was expecting, which was around $4.23. Now, it wasn't a huge miss, but it was just enough to signal a potential slowdown ahead. And the market reacted immediately. The stock dropped 1.8% on the day of the announcement. This wasn't a panic sell-off or anything, but it was a very clear signal of disappointment. It just shows you how focused the market is on forward momentum, not just past performance.
So let's just synthesize the market's main anxieties here. First, that Q4 guidance implied a bit of a step down from Q3's record earnings. Second, management was very, very clear that they expect the volume weakness in Europe to continue with no obvious catalyst for a rebound anytime soon. And third, if you zoom out, this all comes in the context of the stock already lagging both the S&P 500 and its peers in the materials sector over the last year.
Okay, so that's the setup. You've got this best-in-class execution clashing with a really cautious macro outlook. Now let's turn to our forward-looking analysis and talk about what we'll be watching for in the next call. Here's what we're watching. First and foremost, the Q4 results, and even more importantly, that initial outlook for fiscal 2026. That's going to set the tone for the entire year. We'll also be hunting for any signs that those European volumes are finally hitting a bottom. Beyond that, any news on final investment decisions for those big backlog projects, and of course, the pace of share buybacks will be really key indicators of management's confidence. So for our next call prediction, we're expecting an inline quarter. Look, Linde has a great history of meeting its guidance, but given how cautious management sounded, especially about Europe, a big beat just seems unlikely. Expect them to land squarely within that 410 to 420 range.
And in terms of what the stock price might do, we see it as pretty much range-bound for now. Without some kind of positive surprise on volumes or a more aggressive outlook for 2026, it's just really hard to see a catalyst that breaks the stock out of its recent trading pattern. It's a show-me story right now.
And that brings us to our rating. We're initiating with a market perform. And this really reflects the difficult balance for the stock right now. On one hand, you have a truly best-in-class operator that's just generating huge cash flow and executing flawlessly. But on the other hand, you have these undeniable macro headwinds and a valuation that already reflects a lot of that operational excellence. The company is performing well, but so is the market's expectation.
And just a final reminder for everyone, this explainer is for informational purposes only and is not financial advice.